Hi everyone, I'm Simon Hawkins. I'm from Hong Kong, from Latham Watkins. I'm going to talk today about the legal and regulatory framework for virtual assets in Hong Kong. And I think to start with is helpful just to kind of level set how we got to where we are. So this slide basically shows you where we are now, and I'm going to start by explaining kind of how we got there. So we look back to 2018. And the SFC, the securities regulator, like many other securities regulators in the world, was very concerned about ICOs. And in particular, whether the tokens issued by ICO issuers could be securities and the knock-on implications that that would have. If they're securities, the issuance of them can be subject to regulation, and then all the trading activities after that are also subject to securities regulation. So they realized very quickly that token issuances could be structured so that they do not fall within the securities definition in Hong Kong. We do not have a very expansive Howey test type definition in Hong Kong. We have quite a fixed definition of securities that's in the Securities and Futures Ordinance. And so many tokens could be structured to be outside of that regime, and lawyers like me would write legal opinions saying why the token is outside of that regime and therefore could be sold in a completely unregulated way in Hong Kong. So the SFC scratched its head and said, well, how do we expand our regulatory perimeter to capture trading activities involving these tokens without completely revamping our securities laws? And the answer to that was that they figured that the principal area of risk was exchanges. So they would go after regulating exchanges. How to do that if they're not trading securities? The answer was to say, if you're an exchange, you can come to us and we'll license you for all of your exchange activities, but you have to trade at least one security token. If you trade one security token, we'll regulate your entire business, and you can go and tell everyone that you're regulated by a major international regulator. Not many people wanted to do that because the regulations were extremely onerous, but it did give the SFC a chance to create a very formalized process and a series of obligations that they would impose upon licensees who did choose to go and get licensed under that opt-in regime. And there were 2 or 3 exchanges that eventually got licensed that way. In the meantime, the SFC went off thinking again, okay, now we've found a way to regulate under this opt-in regime, but we know there's still a load of tokens out there and exchanges that we can't regulate because they're not securities. So we have to find another handle for us to be able to regulate this industry. But our hands are a bit tied because we're subject to the Securities and Futures Ordinance that says we can only regulate securities. So they came up with a way to do it by incorporating new amendments to the anti-money laundering laws in Hong Kong, to follow the VATP guidance and to regulate virtual asset service providers. Now, unlike MICA, we in Hong Kong do not regulate token issuers, we don't regulate brokers, we don't regulate custodians under this regime. We only regulate centralized virtual asset trading platforms. That's the only category of VASP that is regulated under the Hong Kong regime. And the SFC has now taken that regime, and they've created a lot of obligations and a whole framework around licensing requirements that we'll speak about in a little bit more later. But the virtual asset definition is taken from the VATP, and it basically means cryptographically secured and transferable digital representations of value that can be used for payments or provide rights to governance or administration of the project. Separately, we have in Hong Kong a regulator who deals with money. It's the HKMA, or the Hong Kong Monetary Authority. Now, they're the banking regulator. Now, they have been tasked with regulating stablecoins, and separately to what's been going on the virtual asset service provider level with the SFC. They have now they are shortly going to be publishing their final proposals for legislative amendments to create a regulatory regime for fiat-linked stablecoins. It will only be stablecoins that are linked to one or more fiat currencies. It will exclude algorithmic stablecoins, and it will exclude central bank digital currencies, etc. Like the FATF, the definition of virtual assets does exclude NFTs. It excludes closed loop kind of loyalty tokens, and it excludes central bank digital currencies as well. So what does it mean for existing regulated entities who want to deal with virtual assets? So the SFC, again, has put in place a wide range of guidance and regulations around intermediaries. So these are broker-dealers, etc., fund managers who engage in virtual asset product distribution. So these could be structured products that are structured as virtual asset products that are structured as securities. Virtual asset dealing services, so people who want to get access to exchanges through a licensed intermediary. Portfolio management, so if you are a fund manager and you have more than 10% of your assets under management as virtual assets, you have to go and get special approval from the SFC and be subject to a whole range of regulatory obligations in relation to your management of those assets. And virtual asset advisory services, so producing virtual asset research, for example. If you are a licensed intermediary like a broker-dealer and you want to engage in any of those activities, you need to go to the SFC and you have additional conditions imposed upon your license. That basically, instead of creating a new licensing regime, they've just bolted on a lot of different obligations that will apply if you're an intermediary operating in that sector. For banks, banks have been extremely reluctant in Hong Kong to provide banking services to crypto companies. Actually, banks in Hong Kong, it's difficult to get onboarded for any company, especially a technology company, but if you're in the crypto space, it's even worse. It's an absolute disaster. So it's been necessary from a policy perspective for the HKMA to go out and say to the banks, you can't just de-risk this sector completely. Here are some guidelines about how you can safely, in a kind of managed risk way, onboard these types of customers. It's even more important now that banks can actually onboard these customers because of the virtual asset service provider regime that's been implemented by the SFC. And the reasons for that will become obvious in a minute. But essentially, if you're a virtual asset service provider and you're getting licensed by the SFC, you have to have a Hong Kong bank account. Therefore, you need a Hong Kong bank to give you that account. So coordinating policy approaches among the regulators in Hong Kong has been a challenge and continues to be a challenge. But the Hong Kong Monetary Authority has come out and said to banks, you can, on a prop basis, invest in virtual assets. Your clients can invest in virtual assets. You can lend money to your clients and take virtual assets as collateral. And you can provide credit card and other payment services for your clients if they want to buy crypto using your bank account. Insurers, the Hong Kong Insurance Authority, you might wonder why this is relevant to kind of crypto products. The reason it's relevant principally is that under the new virtual asset service provider regime, the crypto asset service provider, the virtual asset trading platforms that are licensed, need to have an insurance fund in case there's a breach of the hot wallet, in case there's crypto stolen from them, and they have to reimburse clients. They can get that insurance fund by obtaining insurance, for example, from a Hong Kong insurer, or they can get a bank guarantee, or they can hold funds on account in an insurance fund themselves. But that's the reason why insurers have been kind of dragged into accepting the concept of crypto as well, because if no insurers are going to provide insurance to these virtual asset trading platforms, they won't be able to have their insurance funds. There's also been guidance by the Insurance Authority to say that insurers can create new products where they can accept virtual assets as payment of premium. I don't think anyone's actually done that yet, but there is a path for insurers to do that if they want to. So this essentially kind of maps out all the different pieces of the virtual asset trading platform regime. So as I've said, if you're the virtual asset trading platform in the middle, you have to be the only entities that can get licensed, the centralized virtual asset trading platforms that have an automated matching engine. The regime does not cover OTC brokers. It doesn't cover anyone else who's just doing principal trading. It doesn't cover token issuers. It just covers these centralized exchanges with a matching engine. So if we're not regulating token issuers, how do we ensure that the people buying the tokens are buying tokens that are kind of suitable and safe for them? Well, we're going to impose those obligations instead on the virtual asset trading platform itself. So the trading platform has a range of kind of governance obligations. One of them is that they have to have a dedicated token admission committee. The Token Admission Committee is responsible for diligencing all of the tokens that are admitted to trading. And that means that effectively, instead of saying to the token issuers, you need to disclose, make all the relevant disclosures, your white paper has to comply with X, Y, and Z requirements, like you would do under MiCA. Instead, it's on the exchange to go out and say, we have conducted diligence on this token, we're satisfied that it's not a scam, it's suitable for our clients, and we're going to list it on our exchange. And if you get it wrong, you're going to be on the hook for that, because as part of the governance requirements, there are these so-called managers in charge. These are effectively like senior management responsibility regime, like there is in the EU, which says that if you're one of the senior managers who's responsible for compliance, for example, and you're on the token admission committee, and you list a token that's a scam token, and you sell it to a bunch of people, you're the one who's going to be on the hook in Hong Kong from the SFC's perspective, and you will have personal liability for that. There are a range of investor protection measures. So initially, the SFC's view was that all crypto products were unsuitable for retail and were only available to professional investors who are high net worth individuals, $1 million plus net worth. Their policy stance has kind of changed a little bit on that, and they now have accepted that some crypto products are acceptable for retail, but only the largest cap tokens. And again, the Token Admission Committee has to make sure that those tokens that are available to retail customers are in fact, have high level of liquidity. They have to be listed on 2 different indexes. One of the indexes has to be an IOSCO benchmark submitter. There's a range of requirements. So actually, for retail clients, token access is going to be relatively narrow. For professional investors, it will be much broader. The other important thing about the regime at the moment is that it excludes stablecoins. So you cannot trade stablecoins for retail investors on an exchange at the moment. So the reason for that is that because the HKMA is in the process of developing its own stablecoin regulatory framework, until that's settled, the SFC's view is that stablecoins are not suitable for retail investors. That has an obvious impact on trading pairs, etc., for clients of these firms. In terms of custody, these exchanges cannot use a third-party custodian. They have to establish their own subsidiary, a subsidiary of the exchange in Hong Kong. It has to be licensed separately with the company's registry as a custodian. And then you can only hold the assets, client assets, in a bank account maintained by that entity. So essentially, what the regime's doing is putting everything and ring-fencing it in Hong Kong. In terms of the client, in terms of the hot wallet, you can only have 2% of assets in the hot wallet. 98% of assets have to be held in cold storage. The assets that are held in a hot wallet have to be insured at 100%. And the assets in cold storage are insured at 50%. And you need to have an insurance framework in place, as I've mentioned before. So either you have insurance policy to cover losses, or you have a bank guarantee, or you have to put aside your own funds to compensate others. I think my time is up, but basically there was a case recently which confirmed that cryptocurrency constitutes property and therefore can be subject to a trust under Hong Kong law. Interestingly, in this case, the terms and conditions had changed 3 times, and some customers who are under one set of terms which said their assets were held in trust were able to recover their property, and other customers who are under the terms where it said they were not held in trust could not get their property rights enforced. The virtual asset exchange regime, which I've described, came into effect in June 2023. Everyone's got a year to get licensed, so they will kick into effect in 2024. And as I've said, it is very limited compared to regimes like MiCA. It doesn't cover OTC trading, advisory, issuance, or custody. Stablecoin regime's coming very soon, and the Hong Kong government is very focused on promoting tokenization. They did a very big tokenized green bond recently. So that is all from me. Thank you for your attention.